A very good evening to all. Myself, Kavita Vijay, Assistant Professor, Acropolis Institute of Management Studies and Research. Today, I'm going to explain a very important topic of financial management, that is capital structure and its theories. So let's begin the session. Capital means finance. It means through which sources company can raise this finance, whether equity shares, preference shares, debentures, long-term loans, or retained earnings. So we can say capital structure basically the combination of debt and equity. Here, debt means borrowed funds, equity means owner's fund. So it means capital structure is a combination of borrowed fund and uh, owner's fund. Let's say if company wants to raise amount of 20 crores for its project, then company should go for a single source to raise this fund, or company can go for a multiple sources. Obviously, company will go for a multiple source to diversify the risk. Suppose company will go for a mixture of debt and equity. So the question arises, what percentage of debt should be used and what percentage of equity should be used? And here the concept of optimum capital structure comes. Optimum capital structure is that combination of debt and equity which leads to the maximum value of the firm. It means at the combination of debt and equity, the value of the firm will be maximized and the weighted average cost of capital will be minimum. That is known as a optimum capital structure. Now, the capital structure theories. Many people analyze the capital structure because it is a major part of firm's financial decision and it affects the value of the firm. Every finance manager has to decide a suitable capital structure because it is related to the value of the firm. There is a relationship between the capital structure and cost of capital and value of the firm. So there are major theories which explains the relationship between these three, that is capital structure, cost of capital and value of the firm. So here are the few theories: net income approach, traditional approach, net operating approach, Modi-Gilani-Miller approach. Net income approach and traditional approach is also known as a relevance theory. And net operating approach and Modi-Gilani-Miller approach is known as a irrelevance theory. So let's start with the net income approach or relevance theory. It was given by the Duran, and according to this approach, the capital structure decision is related to the valuation of the firm. It means using more and more debt in the capital structure of the company will reduce the overall cost of capital and it will increase the value of the firm because the cost of debt or the debenture are the cheaper source of finance, and because of that it will reduce the overall cost of capital and it will increase the value of the firm. And to prove this model, Duran has given some assumptions. These are: there are no corporate taxes, the cost of debt is less than cost of equity, the use of debt does not change the risk perception of the investor. And he given a formula, that is V is equals to S plus V, where V is equal to value of the firm as is market value of equity. V is equal to market value of debt. It means value of the firm is a combination of equity and debt. And how we can calculate the market value of equity? It can be calculated through net income divided by cost of capital. In this approach, there are some limitations. The assumptions which were given by the Duran, that was there are no corporate taxes, which is not possible. Taxes are always exist. And one more assumptions which was given by the Duran, that is the use of debt does not change the risk perception of the investor. But it doesn't happen, because if the company using more and more debt in their capital structure, it will change the risk perception, because when company will use the more debt, it means the leverage will be high and it will change the risk perception, because there will be financial risk which will be increased and the investor risk perception will be changed, because the more debt will increase the liability, it will create the burden to the company, or it will increase the liabilities of the company, because for using the debt, the company has to pay fixed payment in form of interest. So it will change the risk perception of the investor. So this assumptions doesn't work in present, or this or we can say this assumption does not work in practical. Now, the next approach is net operating approach, which was just opposite to the net income approach. In net operating approach, Durant suggested that there is no relationship between the capital structure and the valuation of the firm. According to this approach, Durant said that change in capital structure will not lead any change in the value of the firm or the market price of the share, as well as the overall cost of capital. And why it was said? Because when the company will use more and more debt, it will change the risk perception of the investor, and it will increase the cost of equity. And that's why the increasing cost of equity will offset the benefits of using cheaper source of finance. And that's why the overall cost of capital will not be changed, and it will not affect the valuation of the firm. And to prove this model, the RAND has given some assumptions. Basically, assumptions are these: if these things will be present, then only this model will be work. And what are these assumptions? The overall cost of capital remains constant and depends upon the business risk, which also is assumed to be unchanged. The Duran said that according to Duran, that business risk doesn't change and overall cost of will always be constant. There are no corporate taxes. The market capitalizes the value of the firm as a whole. And if the company will use more and more debt in the capital structure, it will increase the risk perception of the shareholder, and it will increase the cost of equity. So at some extent, it will stable the overall cost of capital, or it will overall cost of capital will be constant. And the Durant has given some formula to prove this theory. B is equals to EBIT upon KO. EBIT is equals to earning before interest and tax, and KO is overall cost of capital. Again, there are some limitations, as it was said by the Durant, that the business risk is unchanged, which is not possible. Business risk can be vary. It depends on the variation of earnings, so it can be changed. And there are no corporate taxes. Again, the taxes are always exist. Now, the next theory is a mixture of net income and net operating approach, that is known as traditional approach, and also be known as an intermediate approach. It is a mixture of net income approach and net operating approach. It was said that at some extent net income approach works, but after that net operating income approach starts working. According to the traditional approach, mix of debt and equity capital can increase the value of the firm by reducing overall cost of capital up to certain level of debt. It means if the company is using debt in their capital structure, at certain level, company can avail the benefits of using cheaper source of finance. But beyond the limit, if it will increase the using debt in their capital structure, it will not company will not be able to avail the benefits of cheaper source, because it will at that situation the risk perception of investor will be changed, and increasing financial leverage will increase the cost of equity also. The traditional approach can be viewed in the three stages. First stage, where the company start using the debt in their capital structure. So at this level, the investors are ready for a minimum leverage. So cost of equity will remain same. It will not change their risk perception, because they are ready to take a minimum leverage in the firm. So that's why KE and KD, and the cost of equity and cost of debt, both will remain constant, and that's why the overall cost of capital will be reduced. So at this stage, company can avail the benefits of using cheaper source of finance. And stage two, when company will increase using the debt, at this stage, the risk perception of equity shareholders will be changed, and cost of equity will start increasing. But At this stage, the benefit of using cheaper source, it means the using of debt in the capital structure is large enough, and that will offset the increasing cost of equity. So at this stage, KO will become constant because there is some degree of leverage only. But at the last stage, when company will using more and more leverage or more and more debt in their capital structure, it will increase, it will change the risk, or it will change the risk for the debt investor, as well as it will change the risk perception for the shareholders also. So the KD will also KD will also start increasing, and KE is already increasing. So at this increasing level, the KE will also increase, KD will also increase, and that's why overall cost of capital, it means KO will also increase. This is what traditional approach. We can understand it with the this example. In this example, different capital structure has been given. We can see in the first capital structure, no debt has been used, only 100% equity is used. So the weighted average cost of capital is 11.5%. As the company has started using leverage, or the company has started using debt, that is cost of the portion of debt is 10% and portion of equity is 90%. So the cost of debt is 6% and cost of equity is 12%. At this stage, a slight changes in cost of equity because company has started using debt, or the company is using or leverage. There is a leverage in the capital structure of the company. So financial risk has been changed. That's why cost of equity has been changed. But it is not much. It is only 12%. So overall weighted average cost of capital is 11.4%. It has been decreased because of using debt, because of using cheaper source of finance. Again, in the third, we can see 20% and 80%. The cost of debt is same, the cost of equity is same, because the investors are ready to accept a minimum leverage in the firm, and it has decreased the weighted average cost of capital, and now it is 10.8%. Now when the company has used the more leverage, now the portion of debt is 30% and equity is 70%, then cost of debt has been increased. It will 6.5% and cost of equity is 13%, because at this stage the risk of debt investor and the risk of shareholders, or the risk of the perception of shareholders has been changed, and that's why the KD and KE both has been increased. So the weighted average cost of capital has been increased and it is 11.05%. And gradually, as the company is increasing the portion of debt, or company is increasing the leverage in the capital structure, the weighted average cost of capital is getting increased from 11.8 to 12.25% and then 12.8%, because at this stage the the portion of debt is higher, means there is a risk is high. That's why weighted average cost of capital is 12.8%. So we can see in this form, example, that the capital structure where the debt is 20% and equity is 80%, the weighted average cost of capital is minimum. Why? Because the investors are ready to accept a minimum leverage in the firm. Cost of debt has not been changed at this level. Cost of equity has not been changed. It means at this level, the risk is minimum. So that's why the weighted average cost of capital has been reduced. And at this stage, the valuation of the firm will be higher, or we can say the highest. So this is the optimum capital structure, 20% and 80%. That's it for today. I hope you enjoyed it. Thank you so much.